and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to discuss an issue or a problem, if you will, that we in India seldom have had to debate, the problem of plenty. Last week, the country's forex reserves touched $400 billion. That's more than the reserves held by the central banks of many advanced countries. With the exception of China, India among the major economies now perhaps has the largest forex kitty. Considering that the bulk of this is held in the form of US Treasury bills that on average yield a little over 2%, how wise is it for us to keep adding to our reserves? Sure, reserves are good, but at what point does it become too much of a good thing, and when does that turn bad? Is there a cost to holding such large reserves? Is it commensurate with the benefits? To discuss all this and more, I have with me two experts to give our viewers a 360-degree perspective. G. Padmanabhan, former Executive Director, RBI, and presently Chairman, Bank of India, who will give us, I think, the central bank's perspective, and Anant Narayan, Standard Chartered Bank, who will give us the economist stroke banker's perspective. Welcome to the show, Padmanabhan, Anand. Well, it's taken us about a decade to get from 300 billion to 400 billion, but that's a long, long way from the $1 billion that we had in August 1991 when we started on the reform program. Have we reached the stage where we have far too much? So my first question to both of you is, how much is enough? Let me start with you, Padmanabhan, since it was not so long ago that you were with the Reserve Bank of India and in fact were partly responsible, party to, the squirreling away of these dollars. Padmanabhan?
Well, Mythili, I think yes, today I think we are all patting our back saying that we have crossed the 400 billion mark, but the issue is that whether that is enough is a difficult question to answer, because few years ago you would recall that Reserve Bank of India consciously stopped intervening in the market, thinking that we have had enough and there is a cost to adding to the reserves, the same kind of issues that we are planning to discuss today. But came the volatility of 2011 and then followed by 2013, we were proved woefully wrong. So in an emerging market economy, yes, there are certain international indicators. If you take these international indicators, be it money based, be it debt based, be it insurance based, be it extreme stress based, maybe we will arrive at a number which would give us a comfort. But it's a difficult proposition for the central bank to take a call whether this is enough, because I repeat this point whenever I am asked this question, is the issue that first of all the quality of reserves that we have is different from the quality of reserve that China has, and secondly the kind of outflows that happen, it happen in such a hurry that you will never be able to know whether you have reached a stage where you think that this is enough and no more. And even if you are going by, we need to have enough for, let's say, the transaction based and the precautionary based motives. The transaction, this is a country where the trade is burgeoning. The numbers are increasing in 2 digits, 3 digits. Now, what will be that number to support even that in case we reach a situation when an outflow happens? This is a difficult call for a central banker to take. But having said this, I would think that today we have reached a stage whereby any kind of indicators, we have reached a level, I think, where we can feel reasonably or more than reasonably comfortable.
Anant, would you agree with Padmanabhan? No one ever said the central banker's job is easy, but would you agree that we have enough now, and how much is enough? What is the excess? At the one end, we have China, which has little over $3 trillion now, and those reported they're considering selling some of their US Treasury bill holding. At the other hand, we have extreme countries like Germany with about 200 billion, the UK has only 164 billion, and there are many others with much less. So is there something like a right amount, and how should we measure it in terms of import cover, short-term debt? Which rule of thumb would you prefer, Anand?
No, I broadly agree with Mr. Padmanabhan, Mythili. Look, there are various ways of looking at it. I think the first, the need for the reserves is to ensure that there is global confidence in the Indian financial markets. Clearly, when we were in the middle of the crisis in 2013, there was a sense domestically and internationally that the level of reserves were not adequate at $260 billion in the middle of 2013. So you don't want a situation like that. You want a situation where there is enough comfort and nobody is questioning as to whether the reserves are ample or not. And I think that situation has been reached today. The second point is, RBI tends to be a heat sink, either for excess supply of dollars or for excess demand for dollars, and providing the balancing part whenever there are situations of extremities. Right now we have a situation where we have more dollars flowing in than one would expect. And unless you want dollar rupee to go into a free fall, which has its own implications for the economy as a whole, you would want somebody to stand up and act as the ballast, and in this case RBI is playing that role. Now, to add to Mr. Padmanabhan's point about the quality of the reserves, the reality is a lot of the accretion to the reserves that we are seeing right now is not because of FDI alone or because of current account surpluses. We still in fact have growing current account deficits. It's more because we are seeing an increase in unhedged exposures. We are seeing both domestic and international players betting that dollar rupee is either going to stay stable or go down, and therefore that it is a good time to sell dollars. Now, at that point in time, unless somebody like RBI steps in, you will see dramatic volatility in the FX markets. The last point I'll leave you with is, while 400 looks like a very comfortable number, and by the way, we should add to that probably $30 billion of outright forward purchases as well. So the actual reserves is about $430 billion. It's still short of the overall external debt of the country, which is in the region of 470 plus billion dollars. So one could still argue that there is room to go. Even in terms of percentages of GDP, we are still short of the levels that China, for instance, has, which, by the way, has a very different quality of reserves, as Mr. Padmanabhan mentioned. So there are various ways of looking at it. I don't think there is a right answer here available, but this journey will continue.
Yes, that's true. You're dead right, Anant. And I must tell you, you don't have to agree with Padmanabhan. He's no longer that fearful central banker. He's now a humble banker like you, of course, chairman maybe. Even so, Padmanabhan, the fact is that there is an opportunity cost, whatever you may say, there's an opportunity cost of holding the reserves. That is high because the returns from foreign currency assets are much too low, whereas the domestic interest rate is relatively high. Also, when you look at the cost-benefit trade-off of reserve accumulation, should not one look at something that you also mentioned? How have these reserves been created? In the context of India, these have been built out of capital rather than trade flows. That is essentially borrowed funds. And that makes a huge difference because these are not stable. So you need to factor that also when you look at the cost. Padmanabhan?
I completely agree with you. I think, but that's precisely the dilemma, On the one side, I think not long ago, we were all on the same show discussing what is the level of the rupee. Now, to maintain the level of the rupee, and when these inflows are happening, whether there's going to be permanent inflows or reversible inflows, the central bank has to intervene continuously in the market. That's one part of the story. The second thing is, I must say that in the central bank's priority of things, the cost of reserve or cost of holding reserve is of least priority, because they are more concerned about the liquidity. They are more concerned about the confidence they are able to give it to the market. But having said that, probably time has come that when we have reached a level of reserves which by any standard is reasonably good, the central bank should think about the diversification for increasing their returns. I mean, through various means. There have been several suggestions which have come to the Reserve Bank in the past, be it in the investing in the oil bonds or whatever be it. I think there must be some kind of a diversification which is called for to make sure that the returns improve. That part is well taken, but I think the issue whether on an absolute basis the central bank can feel comfortable and say that no more, I don't think we have reached that stage. And incidentally, I think Anantha Narayanan has always been agreeing with me one way or the other, never because I was a central banker.
Okay, that's what you say, but we'll believe you. But I think we're getting into very dangerous territory because all three of us are agreeing with each other. So where are the fireworks? Anant, I'm hoping you'll provide the fireworks in the answer to this question. Because economists like to talk about the impossible trinity in forex management. That is, you cannot have an independent monetary policy, free capital flows and a fixed exchange rate. One of the two has to give. And now that we've gone in for inflation targeting, our hands are relatively tied. But is that really the case? Because the fact is that the rupee is not really convertible on the current account. So surely we are not bound by the impossible trinity as it is in theory. So is it not possible for the RBI to square the circle? It is simply that they've not chosen to do so. Doesn't the quality of reserves make a difference to the quantity question? And couldn't they do something about, restricting or making it less attractive for the inflows? They're not as helpless as they appear to be, are they, Anand?
No, look, the impossible trinity stands irrespective of which economy you look at. So the point you're making about can RBI do something to control inflows, that effectively is addressing one of the tripods of the impossible trinity by effectively putting some restrictions on the capital flows. So it's a choice which has to be made, and in a country like ours, which is starved of capital, is that really a good choice to make? Look, while we talk about RBI mopping up dollars and creating reserves, etc., I think we have to understand that in the current context, RBI is playing a rather passive role, because it's a function of what dollars are coming into the system, which needs to be mopped up in order to maintain certain levels of dollar rupee, which in a sense is balancing this impossible trinity, as you rightly pointed out. Look, the full data for balance of payments and RBI action in the FX markets is now available for the first half of this calendar year, right? If you look at the actual data, the actual RBI intervention in the FX markets, both across spot and forwards, for the first half was about $30 billion. Now, if you add the current account deficit, FDI, and FPI in equity, which typically don't get hedged, that's merely about $3 to $4 billion, in fact less than that. So the balance, $27 billion, where does that come from? That's, in my view, essentially come in because some people are taking a view that dollar is going to go down against the rupee and therefore building unhedged positions. So this includes exporters selling more forward dollars than importers buying forward dollars. This includes FPI in debt coming in without any hedges. This includes people taking ECBs and not hedging them in the forward market. Now, the moment you have a situation where, and by the way, all of this is also happening amongst many other reasons, because of the fact that interest rates in India are seen as relatively on the higher side, given we have a monetary policy framework which clearly targets on a flexible basis inflation. Now, because therefore interest rate differentials are on the higher side, you are incentivizing selling of dollars as opposed to buying of dollars. And therefore RBI is having to try and manage these three balls in the air by coming and mopping up dollars. So it is a difficult situation. It is a cost, absolutely, as you rightly pointed out, Mythili, but it's a cost the RBI and the government is choosing to take in pursuit of the inflation targeting framework.
Yes, thank you so much, Anant. I can see you warming up because there was a faint suggestion or criticism when you said that RBI has been following a passive policy. But we'll come to Padmanabhan and ask him whether he thinks the RBI should be criticized for that or praised for that, but after a very short break. So please do stay with us. Welcome back. You're watching Macros with Mythili, and in this edition, we're discussing what to do with the Forex reserves. 400 billion. Is that far too much for a country like India? And I'm in discussion with Anant Narayan and G. Padmanabhan. Padmanabhan, the RBI has been criticized. I mean, Anant didn't quite criticize you, but there was just a faint suggestion that he's been criticized for not intervening more aggressively in the market to prevent rupee appreciation. And we've already seen what is done to our trade balance. And while it might have a strong bias for a strong rupee, since it helps to hold inflation down, the fact is that had it intervened more aggressively, reserves would have been even higher. So how much of the bank's stance is driven by genuine operational issues as the lack of instruments to absorb the resultant rupee liquidity, since every purchase of dollars pumps in rupees, and how much of it has been driven by the desire to slow down the pace of reserve accumulation, or was that not a factor at all in this entire scenario? GP?
Right. I mean, there are two things that the market players keep asking from Reserve Bank of India, and one good aspect is this has not changed over the years. This was there even before I entered Reserve Bank. It was there when I was in Reserve Bank. Now that I have left the Reserve Bank, I am hearing the same kind of issues. One which Anant did not mention is that wherever they are facing or they are getting into their books liabilities in dollars or a foreign currency, they must be permitted to keep any kind of reserve requirements or anything out of that in dollars. This in a way will mitigate the problem of plenty to some extent, and also in a way the exchange risk that gets into their books. This is one aspect. The second aspect is they always would like to Reserve Bank of India to aggressively intervene with reference to the rear numbers or whatever be that, and to make sure that the treasury is reasonably comfortable as far as the rupee liquidity is concerned. This is something on which I think there has been an enormous amount of debate and difference of opinion between the market and the Reserve Bank of India. I think while it is fair to say that maybe at times in relation to the liquidity issues, the Reserve Bank might not have got everything right, I think, which in a way was admitted by the former governor himself. But I think there is a cost of this intervention also. I think it will be impossible, given the kind of flows that are happening, if you remember, the entire character of the balance sheet of Reserve Bank of India has changed in terms of what is the basis on which the money creation happens. Earlier, this was all government securities and domestic assets, and now it's all foreign currency assets. So in such a kind of a situation, to what extent the Reserve Bank of India can intervene, or any central bank can intervene, I think there is a limit to this.
Absolutely, it's a difficult call, and central bankers are not gods. They do err. They're ordinary mortals, as we've realized. But Anand, the alternative to reserve accumulation really is a runaway rupee appreciation, which is clearly not acceptable given its implications for our trade balance. And we've already seen what happened to our current account deficit for the first quarter. It touched 2.4. That's very close to the danger mark of 3%. So what really are the options?
Mythili, the reality is, because this debate is happening as to whether the RBI has now too much of reserves, and what is the cost of this intervention, and is this something that the RBI can continue to bear or the government continue to bear, you have this dangerous situation of more people now wanting to sell dollars, maybe at some stage to test whether the hypothesis of RBI's patience actually comes true or not. So you actually be getting more inflows in search of the answer to that question. Now, what can the RBI do out here? No easy choices, but there are some compromises that you can make on the impossible trinity. Now, remember, when people are coming in to sell dollars, they're doing it for two reasons. One, they're expecting dollar rupee to remain stable or to come down, or they think that the positive carry that they get on the rupee will far outweigh any possible depreciation of the rupee, right? And because your interest rate differentials are so much in favor of rupee right now, exporters are incentivized to sell, importers are incentivized to stay away. One way of managing dollar rupee without actually touching dollar rupee spot is to allow the interest rate differentials to come down to a level where importers come in and exporters stay away. Now, because you don't have perfect interest rate parity in India, it is possible for forward premia, at least in the short run, to come down to levels where it no longer provides ample incentive for exporters to start hedging, and instead gets importers to come in. Now, one thing which I've had a suggestion on for the authorities is, RBI has, in this particular year, intervened to the tune of about $30 billion in the forward market. Now, the reason they're doing that is to try and solve the liquidity conundrum and not have to mop up liquidity through OMOs or reverse repos. But the moment they do forward intervention, they actually prop up dollar rupee forward premia, which in turn begets more exporter flows and keeps importers away, and becomes a vicious cycle of more and more of the same. I think that's not the best of options to use. I would strongly suggest that a better option would be for the RBI to stay away from the forward market. Let forward premia, again, because interest rate parity doesn't work on a perfect basis, come down to a level where some balance emerges on its own without the RBI having to mop up inordinate amount of dollars, and then see how it goes.
Oh, that you're dead right, Anand, and you've made the suggestion before, but unfortunately, for whatever reason, it's fallen pretty deaf ears. But suppose for the sake of argument that the RBI decided it does not want to accumulate reserves. What are the alternatives? Could it really kill two birds with one stone, as many have suggested, using Forex reserves to fund infrastructure? This was an argument that was strongly advocated by Montek Singh Ahluwalia, when in fact our reserves were in the region of about 200 billion, but was strongly opposed by many, including RBI, until finally in the budget of 2007, as some kind of a compromise, the RBI was persuaded to lend to a special purpose vehicle, essentially IIFCL. Now that the reserves are once again coming out of our ears, as it were, can we return to this idea? What are the pros and cons?
Okay, I think before that, if I step back and then say that the only way that Reserve Bank can stay away from the forward market, the suggestion that Anand made, is to say that we have no issues as far as the current liquidity is concerned, and I take a call on the interest rate, do more aggressive cuts to make sure whether it makes a difference. That's an experiment that Reserve Bank can try out. Whether it's worth trying or not is a decision that Reserve Bank has to take a call on that. Come back to the question that you raised about the infrastructure. I think this is an issue which has been discussed, but upfront let me tell you this. If, for instance, in China, one of the worry that the international investors have is 1/3 of their reserves is locked up in illiquid infrastructure funds. Now, is that a reserve at all which will help you in terms of fighting a market volatility or intervening in the market? I don't think the international community believes that that's the kind of reserve which the central bank can access very easily to intervene. So that's one problem. The second problem is in a reserve. When we are talking about, if we are the reserve prima facie, as we started in the beginning, is the precautionary motive. It's a war chest. Now, if part of that war chest is being invested, taking on the same country risk, whether this will have any sense, that's a debate on which I think we have not had definite views one way or the other. And the third related issue that comes in is that whenever you are talking about infrastructure funding in this country, an enormous amount of this is on account of, which happens on account of import component, not necessarily for the domestic. So in a way, there are many more complications on which you need to find answers to before we can take a call that one way out is to use this or a part of this reserves for infrastructure. I am not saying, I am not ruling out that possibility, but I am saying that there are many more complicated issues on which we need to find an answer, and it cannot be just because we don't want it here, push it down to the infrastructure sector. There are issues.
Anant, what is your take? Because the fact is that investors still have far more confidence in China rather than India. So clearly whatever China does, it doesn't take away from their confidence. And reserves essentially are kept in assets like US Treasury bills precisely because we want to ensure that they are safe. So how wise is it to use it to finance infrastructure like China does, which in India's case is perhaps the most risky form of investment? Using Forex reserves to fund infrastructure could also entail other risks such as increase in money supply, the breach of the government's fiscal deficit target, and so on, that under the inflation target regime could pose a risk to the entire inflation target. Or can some of these adverse effects be offset by, as Padmanabhan said, by higher import of goods? Because you have to decide, do you need infrastructure more or do we need reserves more? Anand?
Look, Mythili, I'll make a few points out here. The first is, given that our level of reserves is climbing, I think it's a fair question to ask as to, are there ways in which we can manage the investment of the reserves better? And that's always the right question to ask, and we should have a debate around that. You have to be conservative in the way you manage your reserves, but within defined rules, you can explore better ways of getting a better return on the reserves, just as a good fund manager would do. In fact, one of the suggestions that has been touted, and I've been a votary of that as well, is why do we need to invest our reserves in gold when we have so much of private holding of gold in the country anyway, as a useless kind of currency? You would rather invest that in things like a special petroleum reserve or oil, which frankly is a scarce commodity for us. But that's a separate topic altogether. How do you invest your reserves and get the most out of it? Second point I want to make is, every time RBI buys dollars, it anyway releases rupee liquidity into the system, which can be used as a multiplier for the banking system to lend to infrastructure, to lend towards consumption, etc. It is already doing its bit in terms of providing liquidity to the system for further use. Now, if it starts to deploy the foreign currency as well domestically, it's actually adding to the multiplier. I'm not sure that's a very smart way of managing things, but it's worth a debate. Third part is, if you're having this question right now of, again, infrastructure financing, because our reserves have gone up from the beginning of the year, $360 billion to over $400 billion now, we must remember what we discussed in the beginning, which is that the quality of this increase is not necessarily permanent. It appears to be a lot more short-term, speculative almost inflows coming in, rather than permanent FDI, permanent current account surpluses, or even FPI in equity. So given that the quality is short-term, committing long-term financing internally towards funding infrastructure, I'm not so sure is a very good idea. Last bit, look, yes, we need financing for infrastructure, but there is ample amount of scope for our infrastructure companies and for our private sector companies to raise reasonably cheap funding overseas on their own. Why is it that RBI has to step up and do more financing, as I said, with all the complications of adding to the multiplier and creating more liabilities within the system, etc.? I'm not sure that really is required in a time like this. In fact, I would recommend that entities should be going out, and as long as they have viable plans, there is ample availability of liquidity globally right now. So all in all, look, it's worth having a debate, but I'm not so sure it's a great idea to have RBI, compromise on the quality of the permanence of the reserves by doing stuff like this, which is more commercial in nature rather than regulatory.
Yes, we will save that topic for our next debate with Padmanabh and you joining us on whether we should use Forex reserves specifically for infrastructure. And on the point that there's enough money available abroad, if you look at the hysteria in the IPO markets, I would say there's enough money available even in India. Yeah, sure. The problem is that infrastructure is seen as such a risky sector. Nobody wants to touch it with a barge pole, and there the fault lies essentially with the government. There is no trust with anything where the government has a say. But I'm afraid we'll have to close this discussion now as we've completely run out of time. Thank you so much, Padmanabhan and Anand, for joining me in the discussion and sharing your views on what to do with our bulging reserves. And I do hope the government and the RBI, your former employer, Padmanabhan, takes your suggestions seriously, because there clearly is a situation where you can have too much of a good thing. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now. In case there's any topic that you'd like to see discussed in this forum, please do write into us at the email ID you see at the bottom of your screen.